Why Warren Buffett's wisdom still matters. In a world obsessed with quick profits, viral stocks, and overnight riches, Warren Buffett stands as a rare symbol of patience, discipline, and long-term thinking. While markets panic, trends change, and investors chase the next big thing, Buffett quietly follows principles that have worked for more than half a century. Warren Buffett is not just one of the richest investors in history, he is proof that long-term investing is not luck, but a mindset. His success didn't come from predicting markets, timing crashes, or following hype. It came from understanding businesses, trusting time, and letting compounding do its magic. Many investors fail not because markets are unfair, but because they think short-term, they react emotionally, they confuse speculation with investing. Buffett's advice cuts through this noise. His philosophy is simple, but not easy. It demands patience in a world that rewards speed, and conviction in a market driven by fear and greed. This is why Buffett's long-term investing advice is more relevant today than ever before. Think like a business owner, not a stock trader. One of Warren Buffett's most powerful lessons is this: if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This single idea separates real investors from gamblers. Stocks are businesses, not tickers. Buffett does not buy stocks, he buys businesses. When most people look at a stock, they ask, is the price going up? What are others buying? What's the short-term news? Buffett asks different questions. Does this company have a strong business model? Does it generate consistent profits? Does it have a competitive advantage? Will it still be relevant in 10 to 20 years? He treats every investment as if he is buying the entire company, not just a piece of paper that can be traded tomorrow. Why this mindset wins long-term? Markets fluctuate daily, but great businesses compound value over decades. When you focus on ownership instead of price movement, volatility becomes noise, not danger. Market crashes become opportunities. Time becomes your greatest ally. Buffett understands that time rewards quality. A strong company held for a long period can outperform dozens of short-term trades filled with stress and mistakes. Patience is a competitive advantage. Most investors think intelligence wins in the stock market. Buffett disagrees. He believes emotional control beats intelligence, patience beats activity, discipline beats prediction. In fact, Buffett once said that the stock market is a device for transferring money from the impatient to the patient. Long-term investing is not about doing more, it's about doing less, but doing it right. The power of compounding, Buffett's greatest weapon. Warren Buffett has often called compounding the eighth wonder of the world. Yet, most investors completely underestimate its power. They want fast results, quick profits, and instant success, exactly the opposite of how compounding works. Buffett's fortune was not built overnight. In fact, more than 90% of his net worth came after the age of 50. This single fact alone explains everything about long-term investing. What is compounding, really? Compounding is not just earning returns. It is earning returns on your returns, year after year, without interruption. Here's the key idea: money grows slowly at first, then steadily, and finally exponentially. Most people quit during the slow phase. Buffett never did. He understood that time is more important than timing. Why time beats talent? Many investors believe success depends on market predictions, perfect entry points, complex strategies. Buffett believes success depends on starting early, staying invested, avoiding major mistakes. You don't need genius-level intelligence to benefit from compounding. You need discipline and patience. Buffett once said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." That statement is humble, but powerful. Consistency is more important than big wins. Another critical lesson Buffett teaches is this: you don't need extraordinary returns. You need reasonable returns for a very long time. A consistent 10–12% return over decades can outperform high-risk strategies, frequent trading, emotional decision-making, compounding rewards, stability over excitement, quality over hype, long holding periods over constant action. The cost of interrupting compounding. Every time you panic sell, jump in and out of stocks, chase short-term trends, you break the compounding chain. Buffett avoids this by holding great businesses for decades, rarely selling unless fundamentals change, letting winners run instead of cutting them early. He knows that the biggest enemy of compounding is impatience. Buffett's secret advantage: staying invested. Buffett doesn't try to predict recessions or crashes. He accepts volatility as the price of admission. Because Markets go up and down. But great businesses move forward over time. By staying invested through crashes, booms, and corrections, Buffett allows compounding to do its work uninterrupted. Why Buffett ignores market timing, and why most investors fail because of it. One of the most dangerous illusions in investing is the belief that you can consistently predict the market. People spend endless hours asking, is this the right time to buy? Should I wait for a crash? Is the market too high? Will prices fall next month? Warren Buffett has heard these questions for decades. His response has remained unchanged. I have no idea what the stock market will do tomorrow, next week, or next year. And that is exactly why he succeeds. The myth of market timing. Market timing sounds attractive because it promises control. Buy at the bottom, sell at the top, avoid losses, maximize gains. In reality, market timing is one of the fastest ways to destroy long-term wealth. Why? Because it assumes you can predict the future. You can control emotions under pressure. You can consistently outsmart millions of participants. Buffett rejects all three assumptions. He understands a simple truth. If market timing worked consistently, everyone would be rich. But they are not. Even professionals fail at timing. Studies repeatedly show that most professional fund managers fail to beat the market long term. Market predictions are often wrong, even by experts. Missing just a few of the best days drastically reduces returns. Buffett knows that timing mistakes cost more than bad investments. When investors try to time the market, they often sell after prices fall, fear. Buy after prices rise, greed. Miss recovery periods. Lock in losses permanently. This behavior destroys compounding. Buffett's alternative. Time in the market. Instead of timing the market, Buffett focuses on time in the market, business quality, long-term earnings power. He believes that owning productive assets over long periods is far more powerful than trying to jump in and out. Buffett famously said, "Our favorite holding period is forever." This is not laziness, it is strategy. Why volatility doesn't scare Buffett. Most investors fear volatility. Buffett welcomes it. Why? Because volatility creates mispricing, separates emotional investors from rational ones, offers opportunities to buy great businesses at discounts. Buffett compares the stock market to a moody business partner. Some days he is euphoric. Some days he is depressed. Buffett listens, but he does not follow. He acts only when prices offer value, not when emotions dominate. Market crashes. Threat or opportunity. To most investors, crashes mean panic. To Buffett, crashes mean opportunity. During market downturns, prices fall faster than business value. Fear replaces logic. Quality assets become cheap. Buffett's approach during crashes: stay calm, increase ownership of great businesses, ignore headlines. He once said, "Be fearful when others are greedy, and greedy when others are fearful." This is not a slogan. It is a disciplined mindset. Why waiting for the perfect moment fails? Many investors stay in cash waiting for the perfect entry, the next crash, absolute certainty. Buffett warns that certainty never comes. Markets move while people wait. By the time fear disappears, news improves, confidence returns, prices are already higher. Buffett understands that waiting feels safe, but often costs more than acting rationally. Dollar cost averaging. Buffett's practical advice. For everyday investors, Buffett strongly supports regular investing, ignoring short-term movements, buying consistently over time. This approach reduces emotional stress, removes timing pressure, aligns perfectly with compounding. Buffett even advised that his own wealth be invested this way for his family. That alone speaks volumes. Emotion is the real enemy, not the market. Buffett doesn't try to beat the market. He tries to control himself. He believes fear causes people to sell low. Greed causes people to buy high. Ego causes people to overtrade. Market timing magnifies all three. Long-term investing neutralizes them. Buffett's core belief about markets. Buffett sees the stock market as a place to buy ownership in productive businesses, a machine that rewards patience, a test of temperament, not intelligence. He accepts uncertainty as permanent. Because the future has never been predictable, yet markets have always rewarded long-term owners. What Buffett actually times. Buffett doesn't time markets, he times value. He waits for a great business at a reasonable or undervalued price, with long-term durability. When those conditions appear, he acts decisively, without worrying about short-term movements. Buffett's rules on risk. capital preservation, and the true meaning of winning. If there is one word Warren Buffett takes more seriously than returns, it is risk. To Buffett, investing is not about making the most money. It is about not losing the money you already have. This philosophy is the backbone of his long-term success. Buffett's two most famous rules. Buffett famously said, Rule No. 1. Never lose money. Rule No. 2. Never forget Rule No. 1. These rules are not literal. Buffett understands that losses happen. What he really means is, avoid permanent loss of capital. Avoid businesses you don't understand. Avoid risks that can wipe you out. Temporary declines don't scare him. Permanent damage does. Risk is not volatility. Most investors define risk as price movement. Buffett disagrees. To him, volatility is normal. Market swings are emotional noise. Price changes do not equal danger. True risk is investing in businesses you don't understand, using leverage carelessly, overpaying for growth, ignoring fundamentals. Buffett once said, risk comes from not knowing what you're doing. That single sentence summarizes his entire risk philosophy. Capital preservation comes first. Buffett believes that you can't compound what you lose. Big losses require even bigger gains to recover. Survival is the first objective. That is why he avoids excessive debt, speculative assets, overly complex financial instruments. He would rather earn moderate, predictable returns than chase high returns with high risk. Margin of safety. Buffett's protective shield. One of Buffett's most important principles is the margin of safety. This means buying businesses below their intrinsic value, leaving room for error, protecting yourself against uncertainty. No analysis is perfect. No future is certain. The margin of safety exists to absorb mistakes. Buffett learned this concept from Benjamin Graham, and it became a lifelong rule. Why Buffett avoids leverage. Debt amplifies both gains and losses. Buffett understands that leverage increases emotional pressure, forces selling at the worst times, turns volatility into catastrophe. That's why Berkshire Hathaway is conservatively financed, highly liquid, built to survive extreme scenarios. Buffett prioritizes staying in the game over winning quickly. The importance of temperament over intelligence. Buffett often says that investing success has little to do with IQ. What matters more? Emotional stability, rational decision-making, long-term discipline. Many brilliant investors fail because they panic during downturns, chase trends, overestimate their abilities. Buffett wins because he knows his limits and respects them. When Buffett sells, contrary to popular belief, Buffett does sell, but rarely. He sells when the business fundamentals permanently deteriorate, management quality declines, his original investment thesis breaks. He does not sell because prices fluctuate, markets panic, others are selling. This discipline protects capital, the ultimate definition of success. For Buffett, winning is not beating the market every year, making headlines, taking bold risks. Winning is protecting capital, compounding steadily, letting time work quietly. He measures success in decades, not quarters. Final message. Buffett's complete long-term philosophy. When all parts come together, Buffett's philosophy is clear. Think like an owner. Respect compounding. Ignore market timing. Protect capital at all costs. This approach may look boring, but boring has made Buffett one of the greatest investors in history.